Hi, everybody. Thanks for joining me today. My name is Justin. Today, I want to do a stock analysis on Lowe's, ticker symbol LOW. There's been a few subscribers that have asked me to do more videos on stocks that pay dividends. So this one is for you guys. And Lowe's is a company actually has been on my watch list for several months. This is a company I like quite a bit. So they're reporting earnings this week. And so going into earnings, I'm asking myself, what is a good buy price for Lowe's? So we're going to take a look at kind of where they've been as far as earnings history goes, what to expect this week on earnings. They report just in a couple of days, and we're going to jump into the fundamentals, and we're going to do a 5-year comparison on information from the P&L, the balance sheet, the cash flow statement. And then we're going to look at valuation for this company. And I'll give you a target buy price that I have on this company if I am interested in them. And if this is the first video you've watched of mine, my name is Justin. I'm an accountant by day, and I am a YouTuber and investor at night. So I try to use my accounting knowledge to bring value to you guys. So let's just jump right into this video. So Lowe's right now is trading at $190. Over the past year, they've been all the way at around $150, $154 up to $190 today. That's about a 23% increase. So they have not increased as much as the market, but nonetheless, they have increased. Solid company. Right now, their PE is around 20. That seems pretty high to me. I know that's probably fairly normal for today's market, but 20 is pretty high in my personal opinion. Now, earnings per share at a 9. With it trading at 190, I would think that EPS should be higher. But with the PE being 20, that makes sense. Now, I will say that the whole Rona situation really impacted Lowe's in a positive manner, where a lot of companies had issues during the pandemic, maybe had to shut down restaurants, or whatever the case may be. Lowe's actually benefited. So a lot of people staying home, got all these stimulus checks, and they couldn't travel or didn't want to travel, so they just started improving their home. And so Lowe's, Home Depot really saw an increase in revenue and earnings, which we'll see here in the numbers. So just keep in mind, this earnings per share of 9, I think, is actually inflated by a little bit. I would say if they were if it wasn't 2020 wasn't such an abnormal year, they probably would have been around an 8.5, 8 to 8.5, somewhere around there. Now, this company does pay a 1.6 dividend yield, which we'll get into more on the dividend in a little bit. It's a lot of reasons why people own this company. Now, I mentioned before that they are reporting earnings this week, and they are estimated to come in around $27 billion of revenue and an average of almost 4 of EPS. So we'll kind of see what happens. Now, I will say the management is really, really fantastic in the way that they have beat earnings consistently over the last several quarters. Really, the only quarter last 4 that they did not beat was October of last year, but that was pretty much a push. They barely missed it, and 2020 is such an abnormality anyway. I can't blame them for missing it, but you can see that they had double-digit most of the time earnings surprises for the benefit. So really impressive. And analysts do think right now this company is going to grow at around 19% according to Yahoo Finance. Now, from what I have seen, I've seen anywhere from 10% to 25% growth over the next 5 years, but I think this is based on sales. In the last 5 years, they've grown roughly around 15%. Roughly, according to Yahoo Finance. I have a little different numbers than that, which we'll kind of get to. But so that's kind of Lowe's on the top side look. They have about 2,000 stores total in the U.S. and Canada. They have about 340,000 employees, and they trade around $135 billion market cap. So very decent sized company overall. So let's jump into the fundamentals and see what's going on there. All right. So what I like to do is take the P&L, which is the income statement. I like to take the balance sheet, and I like to take the cash flow statement and take some of the metrics I like to look at, determine how well the company is growing, how well it's managed, and dump it into graphs visually easy to see kind of going on with the company. All right. So the first couple we're going to take a look at here, we have sales and earnings growth. I want to say it's going up, and we see it going up from $65 billion back in 2017 to about roughly $95 billion last 12 months. So you can see a good uptick. Obviously, the March 2021, that year, fiscal year ended, obviously had the Rona impact. So we really saw a big uptick there. Before that, it was going up, but not a whole lot. It was kind of flattening out. Now, earnings have been pretty good. I mean, they've gone from $3 billion back in 2017 to almost $7 billion trailing 12 months. That's a really good sign. Now, if we look at free cash flow, you can see 2020, there was quite a bit of dip. This is February 2020, so mostly 2019 here. But overall, it has gone up from 2017 to last 12 months. But it's kind of bumpy around here. And in fact, from 2017 to 2020, it was going down. So that is a bit of a concern. You kind of wonder how much impact was made in the last trailing 12 months with the whole Rona, how much that's creating kind of abnormality in their numbers. And we'll look at book value in particular. This really concerns me. So book value is total assets minus total liabilities. And this is what you want to see going up. And it is significantly going down, and it is going down fast. You're talking from $6.5 billion back in fiscal year 2017, which is mostly 2016, to the last trailing 12 months, right now sitting around 445 million. So that is big time concern. That means liabilities are growing a lot faster than assets. Super concerning. If we go down to some other balance sheet metrics, look at total assets. We do see that they're going up, but you can see liabilities are going up even faster. And then you can actually see that's why equity is going down. So how the balance sheet works, it's assets equals liabilities plus equity. So if liabilities are going up really fast, that means equity is going down. That's what we're seeing. So shareholder value is actually going down. So that's not good. Working capital, I like to look at that too. That's current assets minus current liabilities. And obviously this last year we saw a big uptick, but overall it's been like pretty low numbers. You're talking 26 million to 136 million. I know that's still positive, but those are pretty low numbers. I would have expected to see better than that from Lowe. So I see some concern. Equity going down. We've seen book value going down. Working capital is not all that great. But we do see sales going up, earnings going up. But 2020 is obviously an anomaly. Now, if we look at ROIC and ROE, this one's really interesting. So this graph looks so weird because we had that abnormality for this last year, but ROIC is return on invested capital. I like to see 10% or more a year. So basically that's how well management can take capital, which is equity and debt from financing, and then allocate it back in the company and create net income. And Lowe's is really good, really good. I mean, you're 34% to 49%, roughly around ROIC. That's excellent. ROE, I mean, it's even better. So that's return on equity. So that's basically net income over equity. So the reason why we're seeing this go up is because equity is going down, but net income is going up. So this is really odd. This is not normal. So it's bad that equity is going down, but since net income is going up, it's creating a huge variance or uptick in ROE, which is just, again, very, very odd. Now, as far as long-term debt goes, overall, we're seeing this go down. 2019 looks like they kind of got themselves in trouble. So this is basically how many years it would take based on free cash flow for the company to pay off their total long-term debt. I like to see under 3 years, which it is right now. It's about 2.3 years. Back in basically be 2019, they were around 5 years. But at least we're seeing it go down. So that's good overall. And then if we look at gross profit margins, net profit margins, I like to see some consistency, and if anything, going up. Now, gross profit margins have been pretty flat. I mean, basically 32 to 33%. So pretty consistent there. Net profit margins are actually going up. So this is actually good to see. So you're talking 5% back in 2016, basically, down to 3% 2018 and jump up to 7% the last trailing 12 months. So that's kind of in line with what we saw with earnings as well. So that is really good to see. All right, so from here, what I do is I take a bunch of different numbers from the P&L, balance sheet, cash flow statement, and I have some inputs that I put in here. I have some calculations down here, and then I dump it into my calculations tab, and I try to figure out what the CAGR or the annualized percentage growth rates are in different categories. And basically, there are 8 different metrics that I like to look at on valuing a company, or at least telling me how well the company is growing and how well the company is being managed by the management team. And so this kind of gives me a good idea. So sales growth, really any of these. So sales growth, earnings growth, free cash flow, and book value. I want to see at least a 10% growth per year. It gives me a good feeling that the company is growing in the right direction. And then down here, I have management effectiveness. So basically how well company is able to manage their debt, equity, assets, and then be able to turn that into more income and also keeping long-term debt down. All right. So these growth metrics up here, 10% more annualized growth. So sales over the last 5 years is 8% per year. So that's a no. Earnings growth, that's a yes. 17% growth per year. That's phenomenal. Free cash flow growth, 20% per year of the last 5 years. That's also really good. Book value, this is very, very concerning to me that it's going down this fast. I mean, you're talking about 31% going down. So basically, liabilities are increasing by that much per year versus what assets are on average. So that's definitely a no. Overall return on equity, I want to see this going up at least 10% per year, or at least on the average. I want to see at least a 10%. And ROIC 10%. And that's definitely yes on both of these. Now, the last 2 years have been a really big abnormality with Lowe's for ROE, especially. But those are yeses I'll put. Now, as far as current ratio goes, it's kind of looks at the same thing as working capital as far as current assets versus current liabilities. And basically, I want to see for every 1 current liability, I want to see 2 current assets. So that tells me that they have enough cash, enough current assets on hand that they can pay off their liabilities that are due within the next 12 months. And it's well under 2. So that's a no. And then as far as debt payoff go, I want to see it less than 3 years payoff. And they have 2.3 years based on their free cash flow. So I'm going to say a yes there. So we have 5 yeses and 3 nos. So a lot of mixture of kind of good and bad, what's going on with the company. You know, sales growth isn't growing that great, but earnings growth is growing really well. Cash flow is growing well. Book value going down very quickly. ROIC is fantastic. Current ratios, okay, not great. And then debt payoff is pretty good. So I want to make sure, like I said. So now let's go take a look at valuation and kind of see what the intrinsic value I come up with Lowe's. And there's 4 different valuation methods I use. So I do a margin of safety is one of those. So essentially what I'm doing is I'm looking at the earnings per share and then multiplying by a growth rate over the next 5 years and then coming out with a by target price. So EPS was over 9 last trailing 12 months, but I think it should have been between 8 and 8.5 if the whole Roni Rona situation wouldn't have happened. So I'm going to use an 8.5 for my projection here. And basically I come with a $147 target buy price. And right now they're trading at $190. So it's 30% over my margin of safety. Now as a 10 cap valuation, this is essentially looking at total owner's earnings, which is free cash flow, which is cash from operations minus CapEx or capital expenditures, plus tax provision, get to my total owner's earnings, divide that by the total number of shares out there, I get owner's earnings per share of around 11, multiply it by a 10 because I'm willing to pay about 10 times that, and that'd be about $113. And this is kind of a valuation that Phil Town uses that he got from Warren Buffett. Warren Buffett mentioned this back in one of his, I think it was, I want to say 2011 Berkshire Hathaway annual letters on how he determined on how to buy a farm, basically 10 times the owner's earnings per share is kind of how he was looking at things. So 113, so that's well below what it's trading at now. Now, as far as the discounted cash flow, this is basically looking at free cash flow and then projecting out over the next 10 years on what the cash flow is going to be. And keep in mind, stock prices right now are basically the net present value of all future cash flows discounted back to today. And this discounted free cash flow that you see in front of you, I'm giving that away for free. So I did a video recently on how to value companies. So take a look at that video. And then in that video, I tell you how to get this spreadsheet for free. And I'm getting a lot of great feedback from people, and hopefully this is helping people analyze companies. All right. So I try to look at this in 3 different ways. So I can have a low projection, kind of passive, middle projection, which is kind of conservative, and then I have a high projection, which is more aggressive as far as growth rates go. So if we look at what I think is going to be going on the next 10 years, I'm saying 15% growth rate for the next 3 years, 12% 4 to 6 years out, and then growth rate 7 to 10 years out. I typically like to reduce the growth rates as they go out, especially with larger companies. It's harder to grow the older a company is. That's just kind of in general. I'm just trying to be conservative in that manner. I'm using a 15% discount rate, which is my required rate of return. I'm saying future P of 15. I know they're trading at 20 right now, but I think that's too high for this company. And then per free cash flow goes, I'm kind of the $5.8 billion. I know they're around $9 billion, but I think that's too high. In fact, I should have said this in the 10 cap, I reduced this down to about 5.8 as well, because I just think it's that 9 billion is just too much. I mean, with the whole Rona situation, I think people were buying more product than they normally would have. So I don't want to use those numbers because it would inflate my intrinsic value. So I'm using a 5.8, which is basically the average of the last 3 years. So that I feel comfortable with that. And then I have my net debt here. So which tells me there's actually more debt on hand than cash, which is not good. But based on information, I'm coming with an intrinsic value of $141, which is 26% below what it's trading at right now. Now, if I do a higher aggressive projection as far as growth rates, 25%, 1 to 3 years out, 17.5%, 4 to 6 years out, 12.5%, 7 to 10 years out, still discount rate 15, then I come with a $230 intrinsic share price, and that'd be a margin of safety of 20%. But that's some really, really high growth rates. That I don't really feel good about that. That seems too high for me. And then low projection would be like 10%, 7.5%, 5% for growth, and that give me intrinsic value of 92. So I'm saying between 92 and 230, this company is should be valued at, and 141 is kind of the middle. So I'm pretty comfortable with that overall. If we take a look at this, market cap is 134 billion, like I talked about before. Enterprise value is 155 billion. So enterprise value takes market cap, which is just outstanding shares multiplying by the share price, and then it's adding in debt for enterprise value and subtracting out cash. So since this is higher value, that's telling me that there's more liabilities on hand than cash, which we kind of see up here in that net debt number. So you're talking 20 billion. So that's kind of where that 20 billion is coming from. Now, based on this, these growth rates and this projection as well, I'd have a 5-year free cash flow CAGR of 13% and 10-year of about 12%. But again, intrinsic your share price is well under what it what it's trading at right now. So now my last one I want to show you is my price to free cash flow. And essentially what I do is I take the last 5 years of free cash flow right here, and then I divide that by 5. And then what I do is I take that by a multiple. So my multiple I can use anywhere from 5 to a 30. Most of the time I'm using 15 to 20. Lowe's I'm willing to do a 20. It is a growing company. They pay a good dividend, which we'll talk about dividends here in a second. But based on that, I think the market cap should be around 103 billion. It's 134 billion right now. So based on that, on a market cap, I would be willing to pay $147 for this, or an intrinsic, enterprise value would be 117. So quite a bit still lower than what it's trading at right now. If we sum that all up, I have a margin of safety price of 147, 10 cap of 113. Free cash flow to enterprise value of 117, average buy price of 126. And then my intrinsic value based on my discounted free cash flow is $141. So, this is all well below what's trading at as of right now. It's trading at 191. So, based on this information, I would say my buy price is around 125. That's when I would be interested in it. Now we should talk about the dividends, all right? Because that is a big important piece of this company. So this is from my Charles Schwab account. You can see that Lowe's is really a solid dividend payer. So right now they're paying around 1.7 yield, and they have been increasing. So last year they increased it 9%. Year before that, 16, 17%. Year before that, 21%, 24%, 24%, 21%. So they're increasing this substantially year after year. In fact, if you look at their 10-year growth for dividend, you're talking 18%. 5-year growth is 17%. Let me blow this up a little bit and see it better. 3-year growth is 14%. And their payout ratio is 25. So the payout ratio, I like to see under 40%. And we can actually go, if we wanted to, the cash flow to see if they can pay this or not. But with a payout ratio of 25%, I can tell you right now that they can easily pay that, no problem. They could still increase their dividend. So obviously, it's a big dividend company. That's why a lot of people buy into them. So, what's my final verdict on this company? Again, my buy price would be 125. And this is just my opinion. It's not financial advice. But if I were a, dividend person that was really important to me and I wanted to buy a company that's probably going to, do at least some of what the market is doing and still get a decent dividend, Lowe's is not a bad way to go right now. I think Lowe's is a very stable company. They're a company that's in a great industry. There's not a ton of competition. Obviously, there's Home Depot in their same sector. Lowe's is kind of a little brother to Home Depot, but I personally like to shop at Lowe's more than Home Depot because I know the store better. But I don't think Lowe's is a bad at all company to buy into, but I certainly don't think it'd be something that you would get 15% or 20% rate of return per year. I'm trying to get in the well over 20% per year. So Lowe's is not for me, but certainly on my watch list. I like this company a lot. I will continue to watch and we'll see what they do for earnings this week. I'd love to hear from you guys. I mean, what do you think about Lowe's? Do you own Lowe's? What's your buy target price? What other companies do you want me to talk about on this channel? Love to hear from you guys. Thank you so much for watching. I'll talk to you guys on the other side. Take care and God bless.